Good afternoon, all. We are Team 17, and we are here today to talk about Mr. Ty Lannister's 2017 taxes. So we have before you is just a summary of tax topics we'll be going through, and the structure we've laid out for you folks today is that my associate here, my colleague, will be just giving you some bottom line numbers in the first slide. And then I will be discussing the next three slides, which were the specific issues Mr. Lannister raised for us to address. And then my colleague again will take it off with some other issues that are going to affect his 2017 taxes. And then at the very end, we can wrap it all up with a more comprehensive breakdown if we have time. So with that, I will pass it off to my colleague.
Okay, good afternoon. So, Mr. Lannister, based on the information that you provided to us, your taxable income is $951,050, and that includes your wages that you earned. It also includes a portion of the settlement that will be included in your income. It includes a portion of the debt forgiveness, and it includes the amount for the wine consumption that you received. And based on that, your tax is going to be $349,231. Now, that may seem like a lot, but keep in mind your taxable income is also high as well. And as we'll explain, we were able to exclude over $3 million from your taxable income. And with that, my colleague will go into our some of the issues that you specifically have questions about.
Do you have a question, Mr. Lannister?
Just please.
Swallowing.
Okay. Well, one thing we did want to mention real quick is that we didn't have any information about withholding. So usually when people have salaries or jobs, they have money taken out of their paycheck. And so you might not have to pay that $349,000 all at once. So we just want to ask that you check with your employer to see if he had any withholding on your salary. So going over to the first issue, or one of the issues that you raised, the divorce settlement. You were considering 3 different options with your future ex-spouse, Ms. Stark. Now, your goal was to use a divorce settlement option to reduce your taxes in 2017. Our recommendation is that based on the Internal Revenue Code Section 215 and Section 71B, we would alter option 1 to qualify as deductible alimony. Now, with alimony, there are about 6 or 7 requirements, which we will make sure for you to complete. But the reason I say alter is because one of your options was to pay Ms. Stark or her beneficiaries $20,000 for 5 years. Now, it's our recommendation that you do not pay her beneficiaries, and that's because any payments other than to Ms. Stark might disqualify any of those payments from being deductible alimony. So we would recommend structuring the payments to end on the sooner of Ms. Stark's death or 5 years, whichever is sooner.
Let's help Ty. What can he give as a bone to her if he wants this to be deductible? What are we going to do about payments to her beneficiaries?
Now, there might be some other tax things that Ms. Stark can set up on her own, like a trust. But for your regards, option 1 would be the best to minimize your taxes. Even if you have to increase the amount from $20,000 to a little higher, it would be in your best option because better than option 2 or option 3.
Why don't I just give her $100,000 land today and be done with it?
Right, so that's actually your worst option. And the reason for that, and we just want to warn you that Ms. Stark's divorce attorney might push harder for option 2, the fair market value transfer of land, because you will not be able to reduce your taxes with a transfer of land. And she will not have to pay any taxes. That's her best argument. And besides, according to Internal Revenue Code Section 1041A, any transfers of property, land, or real personal property, is not taxable.
So would I get, if I go with option 1, do I get to deduct, $100,000 this year?
If you were to give her $100,000 as part of the alimony or separation divorce agreement, then yes, that would be possible. But one of your options was just to do at least $20,000. But that's actually pretty good for each year because it's like a loan without interest. That would go in your behalf. Option 3 would be your second best option for you and Ms. Stark, partially because you'd be transferring property that's been appreciated, so it has built-in gain. And when you, assuming that in that property that you're giving her that was found in your house has collectibles, it would benefit you because you wouldn't have to pay those taxes, 28% on collectibles, if you were selling them in the future. Now, Ms. Stark would have to would have to pay taxes if she were to sell any of that property that you gave her. However, that will not help you in 2017. So your best option is the first one. And so now if we can move down to slide 3 on the bottom left-hand corner, the settlement of the legal structure was another issue that Mr. Lannister raised and wanted us to address. His goal was to maximize his after-tax payout without taking an unjustifiably aggressive position. Now, our recommendation is to structure that $500,000 legal settlement in the following, in this box right here. So we have medical expense, $200,000, because that's what you paid for the cost of your corrective surgery. We have lost wages, $50,000, because you were out for 2 months, and each month you had missed salary of $25,000. And we would recommend to allocate $150,000 to emotional distress and $100,000 to punitive damages. Now, we believe that's a reasonably aggressive position because with regards to the emotional distress, we have a good argument that you had high damages. You were a high income earner, you suffer from continual fear from recurring nightmares, you have pain that was only mitigated by the surgery and not eliminated, you have a change in your routine, which is you cannot shave, you have a fear of being near next to blades. So we have an argument that you had suffered high emotional damages with regard to the emotional distress.
So let me just understand this, because I'm looking at your first slide, and $100,000 of punitive damages is included
Yes.
in Mr. Lannister's income, and also on the same kind of token, we know that his sister is going to fight us in characterizing this as punitive damages.
You know, I've had enough of her. Why don't we just put it all on punitive damages?
So yeah, so how is that gonna? You know, we have actually something that kind of dovetails. He has to include punitive damages.
Yes.
And she hates punitive damage. Why don't we just say it's all emotional distress? Or why don't we kind of stick it to her and say it's all punitive? Why would you not do all emotional or all punitive?
Right, so I believe we have some authority within our work product that specifically says that damages in lieu of a claim is what you should be structuring it as. And so you brought 4 claims against your sister, ex-employer. One was punitive damages, one was the emotional distress. And so punitive damage was one of the original claims in your lawsuit. So the settlement is in lieu of the lawsuit, which a reasonably aggressive position would be to include that claim and at least allocate some of the damages to $100,000.
But a settlement doesn't have to follow the complaint. And it's really, I think we should be very thoughtful about including anything as punitive damages. We can allege that in the complaint, and we, of course, weren't involved in drafting the complaint, but we don't have to give any money for punitive damages. Aren't we harming our client by taxing him on this $100,000?
That is true. $100,000 is includable in your income, and you're also right that the IRS and the tax court will generally defer to an agreement. We found some good authority that says if it's entered into in an adversarial way, that they will respect the agreement. So that is something we can talk about and also include or an update to the calculations as well. So as your continual settlement agreement going back and forth with your ex-spouse, we can change up the numbers if that changes as well.
What do we need to do to document that? Get her to agree with us since it's both in our interest.
Yes, that's true. However, her original interest was to have nothing to punitive damages, and you wanted to allocate something to punitive damages. So that right there is one factor of being adversarial and entering into that agreement. And then the $400,000 out of the $500,000, not including the punitive damages, would be non-taxable or not included in your income according to Section 104A because it's damages from the settlement of a tort action and on account of personal physical injuries. So we would argue that the medical expense, lost wages, emotional damages are on account of personal physical injury. So moving on to the bottom right-hand corner, which is the sale of land, you were also reconsidering selling a piece of land to your friend Littlefinger. Now he offered you half of the fair market value, and your goal in even thinking about selling that land was to obtain a tax loss and make a loan payment in 2018. So our recommendation is that if you were deciding to sell the land, that you would do so not for the tax loss, but just to help you make your loan payments, because according to the sale of land, you will not be receiving a tax loss or a tax
I
gain.
don't understand. My dad paid $3 million for it. If I sell for 600,000, that's half of 2.4 million in loss.
Yes.
Okay.
Yes, that is a huge loss. Now, the rule according to the section 1014A is that the basis, what's subtracting from the sale price, is actually not the loan, not the original cost your father paid. It's the fair market value on the date of his death. Now, the appraisal information that you gave us informed us that $600,000 was that fair market value on the date of your father's death. So that is the amount you get to use to subtract from the sale price. And of course, it must be apportioned as well.
So does it, you say a portion, does it matter if I sell Littlefinger just a piece of plain land, or if I sell him a piece with a wall or other structure on it?
Assuming, well, if different parts of the land have different characteristics of it, like a river running through it, or maybe just a cliff or mountains, then yes, the land, if it's different in value, will have a different apportioned basis. So the way we did in our calculation is assuming all the land was equal in value. And so the basis was $600,000, so assuming it's equal in value, we would take half of the 300, minus the $300,000 he's offering to buy it for, and that would be zero. Of course, if there's different parts of land.
If I sold them
One part with an improvement that might be worth more, I might get my loss.
Yes, that could change. It could change a little bit. However, we would also need to know how the cancellation of debt, which my colleague will be referring to in a little bit, will affect the reduction of basis when it comes to the order, because you are able to get an insolvency in that.
you tax lawyers.
Yes.
Always technical.
But think about this, sir. We are saving you from the risk of if an audit does come, you're able to substantiate any of your deductions, and we'll be saving you penalties and interest in the future by doing it the right way.
Is it too late for him to say, the state, take back this land, I don't want it, just give me the value of it that as an inheritance?
That is something that we also had questions about, because usually when someone dies, and this is not really a tax matter, but as an estate matter, when somebody who's a creditor and has assets to back up those credits passes away, usually the creditors come and take away the asset, or whatever the non-recourse loan is backed up by. Now, of course, the family motto was that you paid all debts, your family all debts, and so you did take responsibility for all the obligations associated with the land. So it is, according to the information we received, yes, that he is responsible for the mortgage.
Was that a mistake? What difference would it have made?
Excuse me?
Was that a mistake on my part? What difference would it have made?
You know, it's never a mistake for a Lannister, as you put it in your own words, sir, to pay back their debts that their family has borrowed. So I do not think that is a mistake. However, I guess strategically, if you had filed either a bankruptcy or some kind of petition, that would have been wiped out. Although there are pros and cons to everything, and we can address that more in a follow-up email if you'd like. So now I'll pass it off to my colleague who's going to discuss some of the other matters.
Okay, so there were several items that we wanted to address more specifically that impacted your tax income for this year. And so one of the things was the business expenses. So you took some steps to venture into the coat making business. And one of those steps was that you had some investigation costs. You paid a consultant to investigate the business and whether or not that would be a good venture for you. Unfortunately, we won't be able to use those expenses for this year. And also you purchased a machine as well, and the cost of the machine won't impact this year's tax return as well. And the reason for that is because you have not yet began the business. And since you haven't yet begun the business, costs related to the business are not able to be deducted. So once the business begins, we can be able to deduct those costs.
Even though I paid them this year?
Even you paid them this year, yes. And so one of the there is a case in Cooks v. Commissioner where the court found that the person had not been in business because there was no revenue, there were no clients, and no product development as well. So once you begin business, you'll have revenue to match with expenses, and we will be able to utilize those costs. Now, with those costs, the investigation expenses, those are considered organizational startup expenses, so we won't be able to expense them all at once. they'll have to be amortized or expensed over a 5-year period. And then with the cost of the machine will have to be depreciated. Again, it means that we'll write off a portion of it each year.
You may be getting to this in the next slide, but my understanding of the cancellation of debt rules is that the insolvency is going to require tied to reduce the basis in the machine. So if it's reduced to 0, how can you get depreciation?
I believe the reduction, because it's all tied to, so that's something that we would have to address in a follow-up email, because we're not exactly sure how that applies to the machine as well.
Okay. So with the cancellation of debt, normally the cancellation of debt is included in income as taxable income. So you are able to get loan forgiveness to the tune of $2.9 million. And so that would normally be included in income. However, based on the information that was provided to us, we determined that at the time of the debt cancellation, you were in fact insolvent. And that was determined by looking at your outstanding debt versus your assets. So your outstanding debt at that time was the $4 million on the loan and the $700,000 for the machine. And then your assets include the manor, the land, and then the value of the machine as well. So your total liabilities of $4.7 million and subtracting your total assets of $2.1 million equals $2.6 million. So that $2.6 million represents an amount of insolvency. We'll compare that to the amount of the debt forgiveness. And so the $2.9 million less the $2.6 million equals $300,000. It's that $300,000 that is going to be taxable. So even though that still seems like a lot, keep in mind that we were able to exclude $2.6 million. That will not be included in your income. That won't be taxable.
What about the settlement agreement? Isn't that an asset?
The settlement agreement.
The settlement agreement?
If he gets anything from the settlement
The
agreement.
500,000.
Yeah.
The 500,000. We did not include that. We did not include that in our calculation because the assets from that hasn't been received as far as we know. So at this time, it wasn't included. However, that's something that we can take a look at further as well.
And in case you put 0 cash on hand, how did you come up with that?
We discovered that he had actually run out of cash, so he had his $575,000 in wages. Then he bought I believe, a $1 million machine. So right there, that would have zeroed him out. So he's actually going negative on that. So we're not sure exactly from the facts, from the information that we were given, how he paid for all of that, because he also paid for the surgery in that year. So we also need to clarify how he got the money to pay for that.
So in addition to the wages that you will receive from your employer also provided you some benefits. And normally employer-provided benefits are included in income as well. However, you do qualify for an exclusion for the employer-provided housing in addition to the meals that were provided to you as well. And since they were provided on the employer's premises for their convenience and as a condition of employment, we're able to exclude that amount from your taxable income. However, with regards to the wine, we did include that in income. And the reason for that is based on the information that was provided to us, the wine resulted in a net loss of $200 per month for the cafeteria. So to the extent that there was a loss, we included that in income for you as taxable income.
Why wasn't it just part of
For my meals. I mean, that's what I drank when I ate.
That's an excellent question. However, under Section 132 for meals to be deductible for employer-operated cafeterias, there has to be a profit. So the revenue versus the operating cost has to be profitable. And based on the information you provided, there was a loss.
So this is under the fringe benefit rule?
Yes.
What about under 119?
Under 119,
For convenience of the employer?
Under 119, that's something that we could take a look at further. There is not explicit rules regarding, or explicit language regarding the consumption of alcohol. But I think that it's a safe position to take as far for the wine consumption. But that's something that we can look at further if there are circumstances that dictate that the wine was provided as a condition of employment. So further, when you change jobs, you also decided to enroll in some courses and take some college courses. Now, there are several education benefits provided in the tax code. So there's the American Opportunity Credit, there's the Lifetime Learning Credit, tuition and fees deduction, in addition to an itemized deduction allowed on Schedule A. Unfortunately, because of your high income and your filing status, we're unable to utilize most of those benefits. We are able to utilize the itemized deduction on the Schedule A, which would reduce your taxable income. However, we decided to go with the standard deduction instead of itemized deductions, and my colleague will address that.
So, you're saying I'm better off taking the standard deduction than deducting the education expenses?
Yes. The education expenses, they would be listed as an itemized deduction subject to a 2% limitation on your income. And so the list of itemized deductions with your high income, there was a limitation. And so that limitation is why we went with the standard deduction instead of the itemized deduction.
If you would like a visual, we can skip over to slide 10 on page 3. So right here we have your deductions calculation, and you can see at the bottom the standard deduction, which the code allows, no questions asked. In your case, is $6,350 to reduce your income, and your itemized deductions with all the limitations applied is $4,970. So if there's more information that increases your itemized deductions, that $4,970 might change, but for right now, the $6,350 is better. However, now, yes?
I'm not seeing my medical deduction here.
The medical deduction for the surgery?
Yeah.
Is that what you're saying? So that income was never included into an income. So it's better not to include it in income than have to include it and then deduct it later on. So because it was never included, it will not be a deduction. Does that make sense?
I paid it.
You did pay it, but also keep in mind that as part of the settlement, you're also being reimbursed for those medical costs as well.
Got it. Okay.
Yes. So one real quick thing to note, because you'll be of your future ex-spouse of the divorce settlement, is that right now you'll be doing married filing separate. So according to what we have here, we have you taking the standard deduction. However, if your future ex-spouse, Ms. Stark, takes the itemized deduction, you will have to itemize as well and utilize that $4,970. So we just want to encourage the communication, at least for tax purposes, and knowing what your ex-spouse will be doing on regards to itemizing or deducting as a standard deduction as well. And then going down to, or if we can go over real quick to number 9, slide 9, just a couple of things just to wrap up. You did have home repairs of $100,000. That is not deductible because the information that we were given did not say that those repairs were linked to, or that your home was used as a business or an income-producing activity, which the code only allows for you to deduct repairs to your home in that regards. However, yes, sir.
So if I had actually used my home, I could deduct the repairs?
Assuming that you used it in 2017 as a business for maybe making code producing activities, then if we have information on that, then yeah, that will change the numbers. However, we also wanted to ask, $100,000 is a lot of repairs to make to a home. What kind of repairs? Those might include some improvements, and we could be increasing your basis. Another couple of other things as well is that the personal exemption, usually everyone is allowed a personal exemption, except in your case, Mr. Lannister, you will not be able to use one because you are phased out. Your high income phases you out. So these are, personal exemption is not allowed. Yes?
You have attorney's fees here as deductible. I'm not sure I agree with that.
Right. So because $100,000 of the punitive damages was included into income, so that means that he could deduct the taxable portion of those attorney's fees. So 1/5 of the settlement agreement was included in income. So he paid our firm $100,000 to handle that as attorney's fees, so we can deduct 1/5 of that $100,000.
I thought the deductibility of attorney's fees had to do with whether it went to generating business income, not necessarily taxable income.
Well, we found I think it was a court case, I'm not sure if it was a tax court or Supreme Court, giving us a formula for that.